Hey, what's going on YouTube? My name is Bo Crable, and today's video I want to react to Meet Kevin's new company, HouseHack. And I think I have a really cool perspective on this because one, I am a startup founder. Two, I understand software in it because it seems like a lot of people are confused on his whole AI software thing. And three, the most previous company I co-founded raised over $15 million in equity. So with that, I see a lot of people on YouTube that are reacting to this, and I've noticed that the people reacting to it, don't really have a background in software and also don't have a background in startups at all. So, I don't have a background in real estate, but I think this might help close the gap where you can understand what's really this all about. A lot of people are saying this is a scam. A lot of people say it's, correlated with a real estate syndicate, which is completely different. So if you think it's the same as Grant Cardone's Cardone fund, it's actually way different. So first off, let me just explain I'll go on my computer real quick. I want to highlight this. So something that's very interesting is Meet Kevin says he's doing an asset value raised. So typically, I'll use this example for my previous company where we raise equity, software company. Okay, so we buy software companies, and when we would raise equity, we're raising at a markup. So what I mean by that is if we're raising, let's say $1 million, we would raise it, let's say, at a $10 million valuation. Because maybe we're doing $1 million in annual revenue, so software companies have usually a 10, 15, even sometimes 20x markup on that value. Here, what he's doing, and obviously it's real estate, so it's a lot different. If the company's just a software subscription company where it makes sense where they might not be making profits, so you base off of revenue, but for real estate, it's definitely not one-to-one. And he gives this example here where there's a public company that has a 2.17%, markup here, where to their book value. So here you're getting, it's practically just a cash value at this point where you buy equity, that's what it is, and that's what the company's worth. So from a risk standpoint, it's really not fair to call it a scam because that's the furthest way, that's literally the best you can do in regards to being extremely fair to investors. So, Meet Kevin probably could have made this easier for himself. Honestly, raising money from his audience and stuff like that, he probably could have raised from venture capitalists at a 2x. He probably could have easily raised 20, 30, 50 million bucks at a 2x valuation with no big deal and not work with anybody here at all. So it's actually very interesting that he's doing this. And obviously, since he's not paying a salary, there's really nothing holding back from kind of being an issue there. So that's what it is. You're pretty much getting a company. You're buying shares into it, and you're not working on it, and you have this crazy maniac who just works extremely hard and hustles all day long that you get for free. That's doesn't seem like a bad deal. Now, the where you make profit from this, where it can be a good investment or bad, is how it does after this. Practically, that's when it comes down to okay, now the company is valued at this, now the company has these assets, how are they going to get returned? How are they going to increase in value, the company? So obviously there's a software component to it, which I'll talk about that in just a little bit, but I want to talk about that towards the end, and I'll explain why. But this is pretty much the basis of the company. So we can see this right here. This is what they're saying. They're going to first buy, under market deals. So that's what it seems like. And I'm no real estate expert, but it seems like that's what his expertise is buying real estate and things like that. Okay, there's other companies that do that, and then they'll rent it out and call it good. And then in the future, they plan to have a software component to it. So if you're thinking from a risk standpoint, what's the risk here? You're buying into a company, and I'm not affiliated, I'm not getting paid to make this video or anything like that. I'm just giving my viewpoint. If you invest in this company, you're getting a valuation one-to-one. So practically, you're just parking your cash to a different account, and you're getting this equity in return, and they buy real estate. So what's the worst case can happen? Well, they buy some real estate, and now you own a company that has some real estate. It's not like they're doing anything risky here. It's not like they're going to build a tech startup that only is going to make money off of their subscription revenue. Let's think about this. Meet Kevin had a lot of different options he could do here. He could have went just software only, where he's going to raise money for a software company. He probably could have raised a really high valuation. And the risk with that is that if no one buys the software, or if he doesn't get enough customers, then that's an issue. And that there's a lot of variables with this. But here, they take the capital, put it into real estate, and they rent out. That's not a low risk thing or that's not a high risk thing to do at all. So then now the upside, which I do think is really cool, which could, as an investor, if there's any value associated with the software aspect, that is definitely going to give it a higher ROI. So the one thing that you have going for you is that this company probably should not be valued at an asset value raise. That's not how it should. It should probably be at least some markup, even if it's a 1.5 to its cash value of when it has its assets. Now, I guess it makes sense because they haven't bought anything yet, but practically as soon as he deploys and has houses and they're getting rental income, and if he does buy, I mean, and even if he doesn't even buy at like an undervalued deal, the company's probably going to be worth 1.5 of the value. So like you'll probably get, like, again, you know, this is not financial advice, but I'm just saying from a valuation standpoint of how like the equity markets work, like there's probably gonna be a markup from that. And then if it does do very well, like if it actually overperforms other like REITs or other real estate like investment things, it probably will have a 2, you know, ish, maybe 1.75 to 2.1, like what they gave in a comparison in there. So that's actually interesting. However, now where that can actually get bumped up quite a bit is if there's value in the software. Now, me as someone who I understand software, I learned to program myself, I'm running a software company right now. A lot of people are really confused on the whole AI situation. So now here's the thing. I really hope Kevin has like, you know, a really smart, intelligent CTO that is working on this, and that would make sense for the company to actually spend money on that. Like if the company is getting rental income, it really makes sense to have a really smart CTO that's working on this. Because the thing is, people are like, oh, Kevin doesn't have software experience. I actually sold a software company without even knowing what HTML was. And this is before I got really, you know, passionate about software and I taught myself programming. But I literally built a software company, hired other engineers because I had the idea, I had the vision. I told engineers what to do. I didn't know the code of it, but I said, this is what I want. I was like, I want something to do like this, okay? And if you're working with really good engineers, you can tell them, this is the idea I have, this is the vision I have. Please tell me if this is possible. And if they say no, maybe you want to find a different engineer. And then if you find one that says, okay, this is possible, but this is not going to be easy, then it's possible. And that's where I think he probably is at right now. I mean, I know he's definitely not doing the coding himself, but if he has good engineers behind him, or if he has a good CTO, if not, you know, if I was running this company, I definitely would put together a really good CTO, pay them a really nice salary, things like that. You know, maybe that's going to go against what maybe he believes in, because it really does seem like he's trying to work really hard to get a return to his followers, which is really cool, because he definitely did not, like, he easily could have went to a bunch of other you know, family offices or PE firms and stuff like that, and easily could have like raised it a bunch of different ways. So anyhow, if they have someone really building this out, like with machine learning and AI, it gets better over time. So if they're actually working on that, and if the deals are coming through, and if they can really analyze, but now the only issue I have with this is the data set. You know, what I mean by this is, okay, if they raise even $100 million, well, how much real estate deals is that going to get you? You know, not a crazy amount, but I mean, hopefully what they can do is they're getting a crazy amount of more deals than what they're actually buying, and then they can kind of see how those deals come out later, because the most important thing for actually having an AI system that's going to be effective and works is if you have a lot of data going into it. You have a lot of testing, you have a lot of inputs, because if, you know, okay, so if you don't know what AI is, it can be as little as like you're just setting some if-else statements like, oh, if this happens, do this. But that's kind of like really, really basic. But there is some really smart, you know, AI. And then if you go into machine learning, which is like, I don't think he's doing machine learning, but anyhow, doesn't really matter. The point is, if they're actually working on this does give a lot of upside. So as someone who's looking from the outside in, you're looking at this, you're buying equity into a company that's going to be buying real estate. That's not very high risk at all, and you're getting a one-to-one valuation. However, if this software thing actually goes right, and if they work on this, and it may take several years, right? It probably will take a long time. If it's valuable at all, either to themselves or to potentially other people, that could really, really skyrocket the company, because now it goes from the company being valued, you know, 1-to-1 to 1.5 to 3, 4, 5, could even be 10x, depending, you know, the total revenue of the software company. So, you know, the risk probably is not too crazy. Now, there is a risk associated with it. You're kind of investing into a new company that has not proven anything, so that is the risk. So I personally believe that if once they execute a little bit, the company should be valued more, you know, in my opinion. So yeah, anyhow, that's my viewpoint on this. If you like this video, please subscribe. I make videos about options trading, okay? So that's what this video is about. So if you are interested in options trading, check out some of my videos, check out my website called Option Scout, where right now we just have a free software you can utilize, and then we're coming out with a really cool, you know, I don't really want to talk too much about it, but a scanner options finder tool, you know, very shortly. So anyhow, I will see you in the next video and talk soon.